Hi there, this is the next video in the series on investment in shares, and there are a number of factors that are working against prosperity in retirement. In this video I wish to look at the continued attack on retirement incomes that's coming from a number of different sources. Now, the first factor is that bank deposit rates have been cut, and we've seen that NAB has recently lowered their deposit rates by 0.5%, which takes it down now to under 5% on their 5-year deposit rate. And at the same time, they're also not passing on the full amount of the RBA cut onto mortgages either. We've also got the government set to announce a number of cuts to private superannuation benefits, which would have severely disadvantaged a majority of genuine savers who are pretty much inadequately funded for retirement. There's been a huge public outcry, and that may well have headed that off in the short term, but the question is for how long. Now, the other factor that's also impacting is the major underperformance by some of the major funds, AMP, Westpac, Bankers Trust, etc. And they've been seriously underperforming for most of the last decade. And even if they wanted to, the mainstream funds just can't buy enough of the really good businesses to make a difference to their performance, because the four major banks, BHP, Rio, Telstra, they just make up too large a percentage of the index. Now, before I look at the next factor, just a reminder that this information is general advice only. So when it comes to private investors, they actually have a lot more flexibility than I think they realise, and selective investing can provide a huge difference to the overall returns that investors make, and probably for less risk. Currently, there's about 35% of superannuation money is currently in self-managed super funds, and the projections are that this trend is heading towards 50%. So clearly investors are dissatisfied with managed funds as a means to grow their retirement super. So private investors also have a conundrum, because they're living far longer, so they need a lot more capital than would have been the case 5 or 10 years ago. Fixed interest and bond-like returns are just not going to be enough to fund the sort of comfortable retirement that most investors are looking for. So they are being forced to look at growth assets, but they worry about the volatility of the market. So where do private investors go? Well, there is a clear pathway to getting higher returns. Investors just need to broaden their thinking beyond what the current norm is. The risks in well-selected equity are actually a lot less than traditional investment approaches. The income returns have consistently been well above the norm for long periods of time. I think that's something that many investors don't really understand. So if you wish to start gathering some more valuable insight into what you can do, then you can access a free short video series on our website by leaving your details. So it's a step-by-step process to building wealth from shares. All you need to do is go to specialistshareeducation.com.au and I'll be able to start sending those to you. Now, there is a further video series coming which will then provide a lot more detail about how to raise investment income. Stay tuned, because there's a lot more information in the pipeline which can help you to build wealth much more efficiently. Cheers.